We've got another question in the front row.
Yeah, so my question is about your overall debt graph that you showed, household debt graph. And I guess my question revolves around, is that really that bad, given the fact that it's logical as people's purchasing power goes up and interest rates drop, if their primary debt is their home, that they're going to buy the most affordable home that they can get for, you know, their payment per month, as it would be. And given that real rates have dropped by a factor of 2 over the last 10 years, it makes sense to me that debt would go up by a factor of 2.
Yeah, no, it's a good question. And John would always point out that that ratio is not apples to apples. The way it's calculated, you know, it doesn't include certain assets or income in Canada that makes that number maybe not comparable to the U.S. I would not stress the absolute number, but the growth and the continued rise in the number in Canada. And I agree that interest rates, you know, when you look at debt service, it's actually very affordable. And I didn't show that number from that McKinsey survey, but they actually show that's not a problem in Canada. The thing I would be worried about is if and when interest rates do go up, then that debt service ratio is out of your control. And I'm personally amazed at the leverage people will take on to buy homes in Canada. Now, you know, if you compare the situation to Canada to what happened in the U.S., it's not the same. Canadians, on average, have more equity in their homes than Americans did. It's a different makeup. We're not incented because we can't write off and deduct interest in Canada, mortgage interest. We're not incented to carry as much debt.
There's a couple of other factors that go into it that Rob alluded to. That so I've spoken to Stats Canada and I asked them the following questions in which they don't really have answers to. So the first question I asked them is, how much of the existing homeowner debt is debt that a homeowner took out to either put back into their business or put back into investments? There's no way to measure this. So in Canada, the cheapest place to borrow money is on your home. So even a businessman who has a successful company would pay 1 to 2% a year more, no matter how good a covenant he's got, to borrow money inside his company as to borrow money on his house and lend it back to his company. So that factor isn't measured. The fact that so that's essentially the numerator, and the denominator is the income, and the income is supposed to be measuring all Canadian personal income. But here's what it doesn't measure. It doesn't measure any income earned by either a businessman or a professional who's incorporated that chose to leave money inside their company. So, which would be pretty well all of them. And we're talking now, in the US, professionals effectively can't incorporate. Where in Canada, they've been able to incorporate for 30 years. So a large part of income in the high end of the marketplace is not being reported at the personal level. So the problem is that there's been no proper study done. You can only look at things a little anecdotally, which is, for example, that the net worth of Canadians is rising at a faster rate, both in percentage terms and absolute terms, than the household debt ratio is. So I suppose the biggest concern you would have is if there was a market implosion of real estate values in Canada, then those ratios would change, and now those numbers could become meaningful.
But I think what I would be more concerned about realistically in the short term is that growth has got to slow, and that means the economic growth in Canada will slow. You don't need an implosion to say that, you know, you're getting to the point where you're not going to be able to borrow as much as you have in the past and your economic growth will be less.